As of the final closing bell on this shortened Black Friday trading session, Opendoor Technologies, ticker symbol OPEN, is trading at exactly $2.34 per share. We witnessed a staggering intraday surge of over 28% today, a movement that has completely shattered the typical low-volume expectations of a post-holiday half-day session. While the broader markets remained relatively flat and many investors were out shopping, Opendoor experienced what appears to be a massive volatility event, likely a combination of a short squeeze and a violent repricing of risk assets in the real estate sector. If you are looking at your screen right now, perhaps on your Robinhood app or through the Fidelity mobile app, you are seeing a green candle that defies the bearish sentiment that has plagued this stock for the better part of 2 years. This is not just a standard fluctuation. This is a signal flare regarding the market's shifting perception of interest rate sensitivity. Expectations regarding Opendoor have been exceptionally grim for a long time. The prevailing narrative, the one you will hear from almost every casual observer and financial pundit, is that the iBuying business model is fundamentally broken, that the company is a cash-burning furnace destined to follow the same path as other high-growth failures of the last few years. The general consensus assumes that high interest rates have effectively suffocated the housing market, making Opendoor's algorithmically driven flipping strategy impossible to execute profitably. Most people believe that without a return to near-zero interest rates, this company is simply waiting to run out of cash. That is the expectation, a zombie company walking toward an inevitable grave. The reality, however, is far more nuanced and potentially explosive. What we are seeing in this price action, and what the deeper institutional data suggests, is that Opendoor has quietly transitioned from a growth-at-all-costs disruptor into a lean, survival-focused market maker that is now essentially a leveraged bet on the 10-year Treasury yield. The reality is that the company has stripped out hundreds of millions of dollars in operating costs, reduced its risk exposure, and is now sitting on a business model that acts like a coiled spring. The moment the spread between mortgage rates and the 10-year yield compresses, the volume leverage Opendoor possesses could generate unit economics that the market is currently not pricing in. While the crowd sees a failed home flipper, the smart money is beginning to see a massive liquidity engine that has survived the worst housing correction in terms of volume since 1995. This disconnect between the bankruptcy narrative and the turnaround reality is where the opportunity and the extreme volatility lie. To understand why this move to $2.34 matters, we have to look at the mechanics of the trade. Today's volume was anomalous. In a shortened session where many institutional desks at firms like Interactive Brokers or Goldman Sachs are running on skeleton crews, seeing this level of buying pressure indicates that someone was forced to cover, or a large systematic fund decided to front-run a January effect. When you trade Tesla stock or Apple stock, you're dealing with massive liquidity and continuous price discovery. Opendoor, by contrast, has a high short interest and a lower float, making it susceptible to violent moves like the one we just witnessed. If you are managing your own funds via Schwab Intelligent Portfolios or engaging in self-investing through SoFi Invest, you know that these types of penny stock moves in companies that were once large caps can be treacherous. Yet they offer asymmetric risk-reward profiles that blue-chip stocks simply cannot match. Let's analyze the core business, because the misunderstanding of what Opendoor actually does is what fuels the disparity in its stock price. At its heart, Opendoor is not a real estate investor. It is a market maker for residential homes. Think of it like a Citadel Securities for houses. They provide liquidity to a seller who wants to exit their position, their home, instantly, for a fee. In exchange for that convenience, Opendoor charges a spread. The problem over the last 24 months hasn't just been that rates went up, it's that volatility in pricing made it impossible to accurately predict what a home would sell for in 90 days. However, recent quarters have shown that their pricing accuracy is stabilizing. The spreads they are charging are now sufficient to cover their holding costs, even with rates at these elevated levels. This proves that the algorithm works in a high-rate environment, provided they don't try to grow too fast. They have proven they can sell homes for more than they bought them for, plus repairs and holding costs, which is the only metric that matters for long-term survival. The recent earnings report gives us further clues. Revenue for the third quarter came in at $1.4 billion, which actually beat the high end of their own guidance. More importantly, they purchased over 3,500 homes. This is crucial. You can't make money as a market maker if you don't have inventory to trade. The fact that they're stepping back into the acquisition market suggests confidence that the bottom in transaction volume is near. They're not expanding recklessly, but they're keeping the engine running. Unlike Zillow, which famously exited the iBuying business because they couldn't control the volatility, Opendoor doubled down on their data science. They believe that their proprietary data set, which spans years of transactions and granular home-level details, gives them an edge that a traditional flipper or a standard real estate agent simply doesn't have. Comment below how many shares of Opendoor you currently hold, and be honest. Are you holding because you believe in the tech, or are you just waiting to break even from a higher entry price? I want to see the sentiment in the comment section. We also need to discuss the macro environment, as Opendoor is inextricably linked to the Federal Reserve. The stock is essentially a derivative of the housing market's health. We have seen mortgage rates hover in the high 6s and 7s, which has frozen the move-up buyer. People with 3% mortgages are not selling. This lack of supply has actually protected home prices from crashing, which has been Opendoor's saving grace. If home prices had crashed 20% like they did in 2008, Opendoor's inventory book would have been underwater, and we would be discussing liquidation. Instead, prices held firm. Now, as we look toward 2025, the conversation is shifting to rate cuts. If the Fed cuts rates and mortgage rates drift down to the 5.5% range, we could see a massive unlocking of inventory. Millions of Americans who have been waiting to move will list their homes. Opendoor thrives on volume. They need churn. A stagnant market is their enemy. A moving market, even one with flat prices, is their friend. Furthermore, we must look at the competitive landscape because with Zillow out of the game and Redfin scaling back its now offering significantly, Opendoor is effectively the last major player standing in the dedicated iBuying space. This winner-take-most dynamic is powerful. If the concept of instant liquidity for homes survives, Opendoor captures the entire market. It is similar to how certain tech monopolies emerge after a sector crash wipes out the weaker players. Investors using Fidelity brokerage accounts or browsing through Fidelity Wealth Management research notes will often see this described as survivorship bias. But in this case, it is a strategic moat built on survival. The company has also launched Opendoor Exclusives, a marketplace that allows them to connect buyers and sellers directly, bypassing the MLS in some cases. This is a capital-light model. If they can succeed here, they reduce their balance sheet risk significantly because they wouldn't need to hold the home themselves, they would just facilitate the transaction and take a cut, similar to eBay or Airbnb. Now let's contrast this with the retail investor behavior we're seeing on platforms like Robinhood Crypto or standard Robinhood investment accounts. The retail crowd often chases momentum. Today's 28% move will likely attract a swarm of momentum traders who don't care about the contribution margin per home or the adjusted EBITDA. They only care that the chart is moving up and to the right. This creates a self-fulfilling prophecy in the short term, where liquidity begets liquidity. However, for the serious investor, the smart friend looking at the fundamentals, the focus must remain on the spread. Are they making money on each unit? The answer recently has been mostly yes, but the volume is too low to cover their fixed overhead. This is why the stock is at $2.34 and not $20. They're proving unit economics but failing on scale due to the macro environment. There's also a fascinating psychological element to Opendoor's product. Selling a home is consistently ranked as one of the most stressful life events, right up there with divorce or bankruptcy. The traditional process involves staging, open houses, strangers walking through your bedroom, and months of uncertainty. Opendoor turns that into a few clicks on a smartphone. The value proposition is undeniably strong. In a world where we order cars via Uber and groceries via Instacart, the idea that real estate transactions will remain analog forever is absurd. The question is not if the transaction will become digital, but when, and if Opendoor can stay solvent long enough to reach that tipping point. When you use investment help tools or look at online investing sites, you are constantly seeking efficiency. Opendoor is trying to bring that same efficiency to the largest asset class in the world, residential real estate.